Hi, I'm PNC Joe, and I only talk about commercial insurance. A vendor's endorsement is an often overlooked aspect of insurance that can be crucial for small business owners who collaborate with vendors. This endorsement protects vendors by covering liabilities arising from their association with your products, but understanding its nuances can be tricky. The complexities of ensuring both parties are adequately covered can pose significant challenges, highlighting a vital need for clarity in business agreements. Keep watching because in this video, we will discuss these important topics. What is a vendor's endorsement? Why do vendors need this endorsement? What does liability coverage for products mean? How does coverage for bodily injury work? What is coverage for legal defense costs? What about coverage for advertising injury? Understanding the scope of coverage and exclusions. How do the limits of liability work? And a bonus topic at the end. Let's go through these points one at a time. A vendor's endorsement is a special addition to an insurance policy. It provides extra protection to a vendor, which is a person or company that sells products. This endorsement helps cover the vendor if something goes wrong with the products they sell, subject to the terms and conditions of the policy. For example, if someone gets hurt by a product, the vendor can use this endorsement to help pay for costs related to the injury, provided the claim is approved by the insurance company. Vendors need this endorsement because it protects them from certain risks. When vendors sell products, they can be held responsible if something bad happens. For instance, if a toy breaks and hurts a child, the vendor could be blamed. The endorsement helps cover costs like medical bills or legal fees, so the vendor doesn't have to pay everything out of their own pocket, subject to policy limits and exclusions. Liability coverage for products means that if a product causes harm or damage, the insurance may help pay for costs related to it, subject to the policy's terms. For example, if a blender sold by a vendor overheats and causes a fire, this coverage can help pay for any damages, provided the claim is valid and within the policy limits. Coverage for bodily injury means that if someone gets hurt because of a product, the insurance can help pay for medical bills and other related costs, subject to the policy's terms and conditions. For example, if a chair sold by a vendor collapses and someone gets hurt, this coverage can help pay for the injured person's doctor visits and treatment, provided the claim is approved. Coverage for legal defense costs means that if a vendor is taken to court because of a problem with a product, the insurance can help pay for a lawyer and other legal expenses, subject to policy limits and exclusions. For instance, if a customer sues a vendor because a product was dangerous, this coverage can help the vendor defend themselves in court without having to pay all the costs themselves, provided the claim is valid. Coverage for advertising injury protects vendors if they accidentally hurt someone's reputation through their advertising. For example, if a vendor says something untrue about another company's product and gets sued, this coverage can help pay for legal costs, subject to the policy's terms and conditions. It's an important protection for vendors who promote their products through ads. The scope of coverage tells vendors what is included in their endorsement. Exclusions are things that are not covered. For example, intentional harm is usually excluded, meaning if a vendor knowingly sells a dangerous product, the insurance might not cover it. Vendors should always read their policy to understand what is and isn't covered. Limits of liability are the maximum amounts the insurance will pay for a claim. If a vendor's policy has a $100,000 limit, the insurance will cover costs up to that amount. If the costs are higher, the vendor has to pay the rest. Knowing these limits helps vendors understand how much protection they really have. The vendor sells the product while the manufacturer makes it. Both can be responsible if something goes wrong. The vendor's endorsement helps protect the vendor, but the manufacturer may have their own insurance. Vendors should work with manufacturers to ensure both have the right coverage and know their responsibilities. When a vendor needs to use their endorsement, they file a claim with the insurance company. The company then investigates to see if the claim is valid. If it is, they help cover the costs, subject to the policy's terms and conditions. Vendors need to provide all the necessary information quickly to make the process smooth and ensure they get the help they need. By understanding vendors' endorsements and the intricacies of commercial insurance, small business owners can safeguard their operations and partnerships more effectively. It's essential to dive into the details of coverage, exclusions, and limits to make informed decisions that protect both vendors and manufacturers against unforeseen liabilities. I hope this video has shed light on the importance of vendors' endorsements and how they can be a pivotal part of a robust business strategy. If you have any questions or ideas for future videos, please let me know in the comments below.